Friends, the topic of this podcast is dealing with opportunity loss. Many of you may be feeling a tinge of regret that you did not buy equities when the markets went hurtling down. However much advisors told you that it's a good time to buy, people told you that you should buy equity when valuations go down, you would have been overcome by fear and past performance. Now, this is something which you need to deal with squarely. Most people make their investments on the basis of past performance at a time when they should not be doing so, and then when performance is bad, they use past performance to stop themselves from making further investments when it is exactly the best time to invest, and then still wait. Now, what are people waiting for? Most people are waiting for time to correct what could potentially be investment mistakes or what could be problems related to portfolios built in one economic context facing an entirely different economic context within a narrow span of time. Aren't we sitting squarely in the middle of this? So that's essentially the problem of most investors. Whether you are a do-it-yourself investor, whether you are an expert investor, whether you're a novice investor, whether you are a new age online driven investor, whatever you may be, this is basically the definition of the problem. You have sought opportunities at the wrong time. You have not taken advantage of opportunities when it was a good time, and now you're not sure whether it's the wrong time or the good time. Every moment in investing experience has value. Time is the essence. So what you make out of time is very, very critical. Let's look at the present context. Most people have not bought the crash. Some have gone to the extent of selling the crash also. Both these people have a very high sense of FOMO, the fear of missing out. Now you need to deal with this squarely. Has the window of opportunity closed? In my opinion, it has not. But the opportunity is not one of buying, but one of refashioning your portfolios. When I say refashion your portfolio, it's not how the bank RMs do, where they go, check the portfolio of the client and tell him everything should be sold. It's not that way. You should take stock of your portfolio, understand which are the investments that will work in the emerging economic scenario into the present context and the future context, and what are the ones which are going to face more adversity. Now let's look at the events of the past few weeks. Clearly, on the one side you have the small and micro enterprises literally raising a hue and cry that they don't have money, that they're not able to pay salaries, that they're not able to run businesses, and that they are running the risk of shutting down. Clearly, the small and mid caps, a very active and a very loved space, is just sitting a few steps above the MSMEs. In fact, many MSMEs are also your micro caps and small caps. The situation is not too great there, you know it. But look at the other end of the spectrum. The big companies are happily raising billions of dollars. So what does this tell you? It tells you that there is asymmetry in the ability to raise capital in the most difficult times, which means that those who are not going to be able to raise capital will lose money and will need to replace those losses with fresh capital. Now, the problem of the MSMEs may well become a problem of those sitting just above them as well, which means that the small and mid caps are probably going to take a very, very long time to get back to the glory days. Not only that, those portfolios have been constructed in 17, 18 and 2019, facing a certain economic context. Today, you face an economy which is probably going to grow in the negative this year, which will grow positive next year to the extent that it will recoup this negative GDP growth this year and only go into growth phases thereafter. So it's a long wait. In this long wait, how many companies which have been bought to the old economic context of 5 to 8% growth can weather the circumstances? How many of those businesses cater to discretionary parts of the economy? This is a question which we need to address. And I'm quite sure that if you're just going to be looking at past performance and saying that I have reached 90% of my cost or 85% of my cost, I only have to reach 15% more of my cost, you are looking at the wrong place. You need to look at how businesses will be able to weather the immediate future and how they will be able to emerge successful. In fact, the number of businesses which will be able to do that is dwindling. And that's a clear writing on the wall, which means that your advisor should be competent and committed to looking at those areas, telling you specifically that, look, this is not going to work out, we are going to have a small loss here, we are working out of this, we'll probably get in there later. Now, how many people can come and tell you that? Importantly, when people tell you that, don't flinch, don't react. Understand that you are getting ready to make your portfolio better. And by doing so, you would be able to overcome the opportunity losses that you suffered in the last few months. Not all is lost. It means that you make fresh investments and you move some of your old investments into fresh investments over a period of time. It doesn't mean you do it immediately. It has to happen over a period of time. Don't wait too long to take out your monies. This is purely a liquidity-driven rally. The opportunity lies in taking advantage of a liquidity-driven rally. How do you do that? The only way that you can take advantage of a liquidity-driven rally is taking some of that liquidity for yourself as well. Another important point which nobody can ignore is that when the printing machines of central banks work furiously, there is going to be a gradual dip in the value of the exchange rates. And that should show up somewhere. So you need a defensive stance in your portfolio and you need to buy some hugely defensive investments as well. So make up your mind. Understand that there is still a lot of opportunity in front of you. Be sure that you don't mind taking a small hit in the near term so that you also get some benefit from this swell of liquidity due to the central banks doing so much of money printing and putting liquidity in the economy. Make sure that you make the most of the circumstances and not worry about what you missed, because if you miss what you need to do now, it would be a double miss. So make sure you don't have an opportunity loss. Make the most out of the opportunity. Understand that you're investing from now to the point when the economy is going to start growing again is needing to be gradual, regular and incremental. This is simply not something that can be a rush job. Happy investing. Do watch our blog and share this video with your friends. Thank you very much for watching this podcast.